Welcome back to the deep dive. Today, we're jumping into the Reserve Rights Protocol, RSR.
RSR, yeah, a big one.
Definitely one of the most, maybe the most ambitious infrastructure plays in Web3 right now.
It really feels that way. The scope is huge.
I mean, this isn't just another crypto project aiming for quick gains. They started out trying to fix, like, actual hyperinflation, real-world problems for real people.
Exactly. People's savings just vanishing. So our mission today, we want to, cut through the complexity, give you the clear picture on RSR.
Okay, shortcut. I like it.
We'll look at how it grew from this specific solution for inflation-hit countries to this massive multi-billion-dollar platform.
And tackle this Web3 BlackRock nickname it's picked up.
Right. What does that actually mean? And we'll unpack the mechanics, how it aims to fight inflation globally now, and what these DTFs, decentralized token folios, really are.
DTFs.
Got it.
Sounds good. Let's dive in. Where do we start? The problem they first saw.
Yeah, let's start right there. The human element is key to understanding the motivation.
Okay, so the origin story here isn't about DeFi yields or complex trading. It's pretty raw. It's about survival almost.
It really is. Our sources really paint a picture of places like Venezuela, Argentina, Colombia.
Yeah, where your national currency just collapses.
Yeah.
Imagine saving money and then poof, it's worth half as much next year.
Yeah.
Or next month even.
Exactly. The money fails its most basic job, holding value. So millions of people, they literally can't save, can't plan. Their wealth just gets eroded.
That's the micro problem, the really human one they started with.
Right. And tackling that forced them to think bigger. Why are these crucial financial tools like stable value, like diversified investments, why are they still controlled by these centralized, opaque systems?
And you mean like traditional banks and fund managers?
Precisely. The traditional asset management world. ETFs, index funds. It's often expensive, bureaucratic, and definitely not open to everyone to build on. It's a closed shop.
So Reserve looked at that and the mess caused by government monetary policy and said, we can do better. Build it open, on-chain.
That's the leap they took. Build a transparent, permissionless alternative. Democratize asset creation, essentially.
That takes some serious guts.
Yeah.
And vision.
It really does. And, it's worth mentioning who backed this early on. We're talking Peter Thiel from PayPal.
Okay, wow. Heavy hitter.
And Sam Altman from OpenAI. When you see names like that investing, it signals they believe this isn't just, tinkering. It's aiming to reshape global finance.
Right. They're betting on a fundamental shift. Okay, so that ambition leads us to the core idea. And the analogy I found really helpful in the sources is this. Reserve isn't one specific product, like one stablecoin.
No, that's key. It's not just a stablecoin.
It's more like the infrastructure, the toolkit. They call it the Web3 BlackRock, right?
Yeah.
Like a factory.
Exactly. The factory analogy is perfect. It provides the machinery, the rails, the safety mechanisms for anyone to create their own custom digital assets.
Assets backed by other assets.
Yeah, asset-backed digital money or investment indexes, these decentralized token folios, the DTFs we mentioned.
Okay, so contrast that. If Makered AO and DAI are like a single car model.
A fantastic one, like the Ford Model T analogy in the sources. Reliable, stable, does one job incredibly well.
And Reserve is the whole automobile factory.
Precisely. It's the assembly line. It provides the secure smart contracts. The insurance layer will get into that so that anyone, a DAO, a fund, even you, could design and build different models.
And these models, these DTFs, they aren't all the same.
Not at all. That's the point of the factory. You can build different things for different needs. The sources break it down into roughly two types.
Okay.
You've got yield DTFs, think stability, lower risk, maybe backed by a mix of solid stablecoins, T-bills perhaps, designed for steady, safer income, preserving value.
Like the original goal for hyperinflation zones.
Exactly. Then you have index DTFs. These are more like your traditional index funds, but on-chain. They track volatile stuff like maybe a basket of AI tokens or like ETH plus.
ETH Plus tracks liquid staking tokens, right? Like Lido State, Rocket Pool's Reps.
Yeah, you got it. So those index DTFs, they come with more risk, obviously, but also the potential for growth, exposure to different market sectors.
So the factory provides the safety standards, the chassis, maybe, but the builder decides if they're making a safe minivan or a risky sports car.
That's a great way to put it. The protocol aims to make the structure safe, but the collateral choice dictates the risk profile. That flexibility is the whole strategy.
All right, let's pop the hood on this factory. How does it actually run? You said creation, insurance, maintenance.
Yep, those three pillars. Let's start with creation.
The fun part.
Maybe. This is where the permissionless buzzword really matters. Anyone can walk into this digital factory. You, me, a DAO.
And just start building.
Pretty much. You define your DTF. You decide the recipe, the basket of collateral assets. Maybe you want 50% USDC, 25% TOSD, and 25% tokenized gold. You set the rules.
You deposit the collateral.
Exactly. The smart contracts lock it up, mint your new DTF token, and it's live. Anyone can then mint or redeem it based on those underlying assets.
Okay, simple enough in concept. But what if that collateral, like the USDC or gold token, goes bad? That's where insurance comes in.
Bingo. Insurance. This is arguably the most critical piece, and it's where the RSR token itself gets its main job.
So RSR isn't the stablecoin itself, it's the protector.
It's the guarantor, the insurer. RSR holders stake their tokens to specific DTFs they want to back. By doing that, they become the first loss capital.
First loss capital, like a deductible on car insurance or a security deposit.
Great analogies. It's the buffer. If the stuff inside the DTF breaks, say, a stablecoin depegs, or there's a hack affecting the collateral,
Then what happens to the staked RSR?
it gets automatically slashed. The protocol sells that staked RSR on the market instantly
And uses the money?
to make the DTF holders whole. To plug the hole, restore the peg, maintain stability, it's an automated, decentralized insurance payout.
Wow. And why would RSR holders take on that risk?
Because they get paid for it. They earn a share of the yield generated by the collateral held within the DTF. Think of it as earning insurance premiums, management fees for being the safety net.
Okay, that's a really clever economic loop. Decentralized insurance funded by yield?
It's sophisticated, yeah. And that brings us to the third piece, maintenance. This involves a deflationary aspect, which is quite neat.
Deflationary for RSR. How?
So remember those index DTFs? The ones tracking volatile assets like ETH plus OR?
Yeah, the crypto ETFs, basically.
Right. Well, just like traditional ETFs, they often charge small management or performance fees. But here's the twist. Instead of those fees going to some company like BlackRock,
Where do they go?
a portion of those fees generated by the DTFs is automatically used by the protocol to buy RSR off the open market,
Okay.
and then it burns it. Poof.
Yeah.
Permanently removes it from circulation.
Whoa. So the activity and success of all these different investment products built on reserve directly reduces the supply of the underlying RSR token.
That's the feedback loop. More DTFs, more volume, more fees, leads to more RSR being bought and burned. It creates this constant, potentially growing deflationary pressure.
Directly linking the platform's success to the value, accrual, or scarcity of RSR.
Exactly. It aligns incentives beautifully. The better the factory does, the scarcer the factory's own governance and insurance token becomes.
That is clever. And you mentioned security before. It seems serious about it.
Extremely serious. You have to be if you're building potential global financial infrastructure, right?
Oh.
Sources say they've spent somewhere between $2.3 and $2.8 million on multiple deep security audits from reputable firms.
That's a lot.
And they have an ongoing $10 million book bounty program. They're basically paying white hat hackers top dollar to try and break their system before the bad guys do. It shows commitment.
Okay, so we've got the factory, the insurance, the tokenomics. Let's talk about who's actually using this. Where does the rubber meet the road for, regular people?
Well, the most powerful example is definitely back in Latin America where this all started.
With the RPay app.
Yeah, RPay was the main interface for a while. It allowed everyday folks in places like Venezuela and Argentina who were getting crushed by inflation.
To do what? Get US dollars.
Essentially, yes. To access stable digital dollars like the USD DTF, which is backed by other stablecoins. It let them protect their savings, conduct business, send remittances, basically opt out of their failing national currency.
And did people actually use it? We hear about adoption, but...
Oh, the numbers are staggering. The sources cite over $5.7 billion in transaction volume processed through the ecosystem since 2020.
Wait, $5.7 billion? Seriously?
Seriously. And the sources suggest a lot of that volume spiked during the worst inflationary periods, like late 2021, 2022.
So not just crypto speculation. This is people genuinely seeking stability.
Yeah.
A lifeboat.
Exactly. Hundreds of thousands of users finding real utility. That's adoption you can't easily fake.
Okay, that's compelling. What about benefits for people not facing hyperinflation, like DeFi users or more traditional investors?
For them, the benefit is different. It's about access to these diversified, transparent, on-chain financial products, the DPFs.
Like the ETH Plus you mentioned.
Right. Instead of buying, say, 3 different liquid staking tokens and managing them yourself, you just buy ETH plus Fed. One token, automatically diversified, earning yield, managed by transparent smart contracts. It's like a Web3 ETF.
Lower fees, more transparency than TradFi.
That's the promise. You see exactly what's backing it, the rules are code, and the RSR insurance adds a layer of security. Plus, you get diversification and yield without needing a brokerage account or trusting a centralized fund manager in the same way.
And are institutions looking at this? Or is it still too niche?
They're definitely making inroads. The sources highlight partnerships with big names in traditional finance data, Bloomberg indices, CoinDesk indices.
What kind of partnerships?
They're launching joint index products as DTS on the Reserve platform. So Bloomberg might design an index, but it gets built and run using Reserve's rails and RSR insurance.
That's huge for legitimacy, isn't it?
Yeah.
Like TradFi renting space in the Web3 factory.
Exactly. It's a bridge. It potentially brings institutional credibility and capital into the ecosystem, making these DTFs more appealing to a wider audience.
Okay, the potential is obviously massive. The ambition, the tech, it's impressive. But no project is risk-free, right?
Yeah.
Especially one this complex. Despite the audits and bounty, what are the big red flags the sources point out?
Yeah, absolutely. There are significant risks. Probably the biggest external one is regulatory risk. It looms large over almost all of DeFi, but especially projects creating new financial instruments.
How so for Reserve?
Well, you're creating these complex, sometimes yield-bearing asset-backed tokens. What are they legally? Could regulators like the SEC in the US or maybe regulators under MiCA in Europe?
Classify them as securities.
Exactly. If RSR itself or maybe certain DTFs get labeled as securities, that triggers a whole avalanche of registration, reporting, and compliance requirements.
Which could totally stifle the permissionless aspect. Suddenly you need lawyers and licenses to use the factory.
It could drastically slow things down, yes. Add huge friction. That uncertainty is a major headwind.
Okay, what about risks inside the system, the tech itself?
That leads to collateral risk. The whole model relies on the quality and stability of the assets backing the DTFs. The insurance is great, but it's insuring against the failure of those underlying assets.
The system is only as strong as its weakest collateral link.
In essence, yes. Now, the good news here is we have a real-world stress test example. Remember the USDC DPEG in March 2023?
Yeah, that was scary. How did Reserve handle it?
According to the sources, the system worked exactly as designed. Some DTFs held USDC, the peg wobbled, and the protocol automatically slashed the staked RSR backing those specific DTFs to protect the holders and restore stability.
So the insurance mechanism actually functioned under fire. That's positive.
It is. It proved the concept. But what if a much bigger collateral asset failed? Or multiple major ones at once? Could the RSR insurance pool get overwhelmed? That systemic risk is always there. Diversification helps, but it's not foolproof.
Right. The insurance is only as deep as the amount of RSR staked.
Precisely. And then there's the centralization risk. Or maybe residual centralization is a better term.
How centralized is it still? I thought the goal was decentralization.
The goal is absolutely. But the reality, as the sources point out, is that a significant chunk of the RSR token supply, something like 49%, is still held in what they call a slow wallet, managed by the founding team.
49%. That sounds like a lot of control.
It is a concentration point. However, they've put a really interesting safeguard on it. It's not just a regular wallet.
The slow card.
Yeah. Any large withdrawal from that wallet has a mandatory 4-week time delay before the funds actually move.
4 weeks.
No.
Oh, so if the team tried to, say, dump tokens unexpectedly.
The entire community would see the withdrawal initiated 4 weeks in advance. It's like a giant public alarm bell.
Giving the community time to react.
Yeah.
Discuss, maybe even fork the code if necessary.
Right. Exactly. It's a check and balance built on transparency. It doesn't eliminate the concentration, but it makes malicious action very difficult and very public. Still, it's a point of centralization that ideally diminishes over time.
Makes sense. And competition must be fierce, too.
Oh, absolutely. You've got established players like MakerDAO with DAI, which is deeply integrated everywhere, and then aggressive new models like Athena with USD offering very high yields. It's a constant battle for users, liquidity, and mindshare.
Okay, we've been through the problem, the factory idea, how it works, the amazing adoption, and the significant risks. Let's try and tie it all together. If you had to boil Reserve Protocol down to its absolute essence for the listener, what is it?
All right, the distillation. I'd say Reserve Protocol has strategically pivoted from just being a stablecoin project into aiming to be the permissionless asset factory for Web3.
The infrastructure layer.
Right. Using its RSR token primarily as the economic engine for decentralized insurance, securing a whole ecosystem of stable and diversified digital assets that anyone can build and access globally.
So the big bet is, the killer app isn't one coin, it's the tools to build any coin or asset basket.
That seems to be the core thesis. They're not just trying to build a better stablecoin tied to the dollar. The long-term vision hints at something bigger.
Bigger how?
Imagine a truly global, stable currency, not backed by one nation's fiat, but by a diversified basket of real-world assets, stocks, bonds, commodities, maybe even things like carbon credits, all managed transparently on-chain.
A new kind of reserve currency, built permissionlessly.
That seems to be the ultimate audacious goal. And it leaves us with a pretty provocative question for you, the listener. If this kind of platform succeeds, if anyone could design a global reserve standard, what would you put in that basket? What assets truly represent stable, long-term value for the whole world? Something to think about.
Definitely something to think about. That wraps up our deep dive into Reserve Protocol. If you found this interesting, please like and subscribe to the channel. We do all the complex research so you don't have to.
Yeah, thanks for joining us as we unpack the really ambitious world of RSR. Hope it was useful.
We'll see you next time for another deep dive.